And welcome back to my channel. If you have not, please don't forget to like and subscribe below. It just helps me. And also don't forget to click the bell button so that you can get notifications when I release any other new video. And if you have any request on what kind of video you want to see, just you can comment below and I'll make those video for you. So let's get started. So topic for today is credit spread. What is credit spread? How to do credit spread? In right now I'm showing in Robinhood, but you can do pretty much in any of the brokerage if you have options enabled. You do need spreads enabled. Let's get started. So this is Apple. So first you gotta, this is an option strategy, so we're gonna go to the um, trade Apple options. So let's I want to go with the debit spread. So in debit spread, so what you are doing is like you're buying a call of the lower strike and you're selling the call of your higher strikes. And I have talked in hundreds of videos like what your max profit and what you could lose. In debit spread, max you could lose is whatever you paid for that, and your max profit is whatever the width of the spread, difference between the strike price times 100 minus whatever premium you paid, whatever your cost was. Credit spread is just the opposite, right? So basically debit spread, you are buying, somebody is selling, the seller is doing the credit spread, that's it. So how do you do it? So in credit spread, what you do is uh, instead of buying the lower call, you sell that one, you buy the higher call. So in this example, let's say I'm gonna do 5 10 20 for Apple. So you sell call 510 and you buy call the higher strike. Let's do 520. 520. Yep. So I did 510. I sold call 510 and bought call 520 expiring 828. And what's your max profit? Your max profit is always whatever credit you get, right? So this is your total credit 230. And what happens to this credit? So if the price of the Apple goes below whatever it is, so right now Apple is trading at 498. So in credit call spread, what you are saying is like the price will not reach your lower leg, so it will not reach 510. Once you start reaching 510, you start losing money. Your break even, basically break even is 220, right? You just add 220 to this 510. So if the Apple by the expiration reaches 512.30, you'll be break even, you won't make anything. If it goes above that, you will start losing. What's your max loss? Your max loss, so this is a little bit more risky than the debit spread, in the sense is so in debit spread you lose what you paid for. In credit spread, when you do that, they will actually put collateral for this amount. So in this you have 5 10 and 520, so you have $1,000 difference, right, in the strike price. So they will put $1,000 in collateral. So if you have a margin, they will probably put a little bit less, but in Robinhood they usually put $1,000 in collateral. So they do need collateral for that, and collateral amount is whatever the difference in the strike price is. And what's your target is, you are basically not bullish but bearish, or maybe you want Apple to move sideways, or if it stays that same, that's good. So if Apple stays the same price, your credit will be like, basically it will show less less less, and you want it to expire worthless, like zero, right, by expiration. Then you got to keep all this $230 within a week. This is a very good strategy, actually one of the theta strategy. So as time passes, you make money. So that's why it's called theta strategy. Basically, theta is your friend. This does not work for, at least call credit spread does not work for a very momentum spread. I mean momentum stocks which moves really high, or probably for Tesla it's kind of dangerous in the sense like, but if you are really far away, right, Tesla running like 18 1900, if you do maybe 28 30,000, 2800 or 3000, it may work fine. But I think I pretty much covered. So your max risk in this trade, right, your max risk is 1000 minus 230, because 230 you already got credit, right? So max this could go is 1000. So you already got 230, so your max loss is 1000 minus 230, that's 770, right? So your max loss, you could lose 770 max. You cannot lose more than that, so that's your max loss. So pretty much pretty straightforward, just the opposite of debit spread. You could do the put credit spread too. So when you do put credit spread, you basically you are bullish, right? The when you do put credit, I mean, I can kind of go real quick. Put credit spread too. So can I not select this? So put, right? I mean, I guess it will do. So in put credit to, same thing, right? You sell, let's say, 485. You sell 485. You 485, and you buy 480, let's say, right? So you got more credit, right? So this is iron condor. This is iron condor. I could not. I guess I could just cancel the call. Yeah, this is put credit spread, right? So you got 485, 480 here. What you are saying is like the Apple stock will be more than 485. If Apple stock within a week, Apple stock is more than 485, you get to keep $155. If it reaches below that, then you start losing. So just the opposite. I didn't want it to make it complicated by putting puts, but it's pretty much same strategy. So yeah, if you have any question comments, just comment below and ask me if you whatever questions you have. But other than that, it's pretty straightforward. Whatever your debit is spread, just the opposite. Like you're buying a lower strike and selling upper strike. Here you just do the opposite. You uh, sell lower strike and buy the upper strike. Only thing is you want the stock, in at least in call, you want the stock to below that lower strike price. That's all you want by expiration. If that happens, you get to keep all the credit. That's it for today, and if you have question or comments, just leave below and I'll reply. And thank you.